Hey everyone, Couch Investor back with the second video of this earnings session. The first one was about Intel. If you missed that one, it's going to be in the top right corner. Now this one, let's talk about Amazon. Amazon beat on earnings per share and revenue estimates. It's up over 7% right now. It was already up over 10%, so now we're a bit down. Of course, during the earnings call, anything can happen. And then on Friday, the market opens, stock can go up even more, can go down as well. Now, to me, this was a good report. It shows that Amazon is and can become a better company when it comes to the profit side of things, and it can also continue to grow as well. Now, of course, a big positive of all of this is that the cloud segment did better than feared. Of course, year over year, the growth rates are down. It's now up 16% year over year, which of course before we saw it in the 20s and then even closer to 30% growth as well. But because the results came in better than what the consensus was, the market views this as a positive. But overall, there are lots of positives to see in this report, which we're going to go over in just a second. But first, a little comment here from the CEO. So there's a lot to like about how our teams are delivering for customers, particularly amidst an uncertain economy. Our stores business is continuing to improve the cost to serve in our fulfillment network while increasing the speed with which we get products into the hands of customers. We expect to have our fastest prime delivery speeds ever in 2023. Our advertising business continues to deliver robust growth, largely due to our ongoing machine learning investments that help customers see relevant information when they engage with us, which in turn delivers unusually strong results for brands. And while our AWS business navigates companies spending more cautiously in this macro environment, we continue to prioritize building long-term customer relationships both by helping customers save money and enabling them to more easily leverage technologies like LLMs and generative AI, which by the way we covered on this channel, with our uniquely cost-effective machine learning chips, Trainium and Inferentia, or whatever they call it, managed LLMs, Bedrock, and AI Code Companion, Code Whisperer. Again, we covered all of this in another video. It's going to be in the top right corner. We like the fundamentals we're seeing in AWS, and we believe there's much growth ahead. Of course, that's exactly what the market wants to hear. Now, before I continue, if you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, we really appreciate that. We'll have a lot of earnings videos coming out for you in the next couple of days and weeks ahead. And if you want to support me even further, do check out the link down in the description and in the pinned comment to get the top 10 best stocks to buy now, or go to fool.com/couchinvestor. All right, so I'm going straight to this very famous table here. So overall, online stores were flat year over year or up 3% on FX neutral basis to $51 billion. Physical stores increased 7%, but I'm not really that interested in that. In the next ones, I would say much more. So third-party sellers is up 18% year over year, close to $30 billion there. Subscription services up 15% year over year to $9.65 billion, also up quarter over quarter, by the way, pretty impressive. Then advertising services, that's up another 21% to $9.5 billion, truly a tremendous business. Then AWS, like I said, up 16% year over year. As you can see here, the growth rates have been coming down from, 40% in Q4 2021 to now 16%. But of course, the market right now is a bit difficult, but overall still growing quite nicely there. And then if you want to have a look at the profitability of each side, also surprising there. So for North America, net sales here $76.88 billion. And as you can see, operating income is now, income and not a loss like in 2022. So again, much improvement there, 898 million. Then internationally, in this case, operating loss is basically flat year over year. Net sales has increased. And then AWS operating income has come down. Again, they explained why, but net sales has increased here as well, which means, in my opinion, when the economy turns, I think operating income will turn as well, or will increase and will become a tailwind. Now, if we scroll back down, we can look at stock-based compensation expenses here. It continues to go down. While it is still up 46% year over year, it is down quarter over quarter and lower than the last 3 quarters. Now, when we look at worldwide shipping, that still increased 2% year over year. But we are flat-ish if you take the average of the last couple of quarters. So, okay, I think it's a positive point, let's say. Then employees. Unlike Alphabet, they did not add more employees this quarter. Actually, it's down 10% year over year, and it's also down quarter over quarter. So, of course, cost cutting, layoffs, etc., will have a positive effect on the profitability on the bottom line of this business. Now, as for the overall business, net sales increased 9% to $127.4 billion. So if you annualize this, yes, it's over $500 billion yearly. Pretty crazy. And this is compared to $116.4 billion in the first quarter of 2022. Now, if we look at net income, you can see that was $3.2 billion this quarter, or 31 cents per diluted share, compared with a net loss of $3.8 billion or 38 cents per diluted share in the first quarter in 2022. Now, this quarter, net income includes a pre-tax valuation loss of $500 million included in non-operating expense from the, of course, common stock investment in Rivian, compared to a pre-tax valuation loss of $7.6 billion from the investments in the first quarter of 2022. So again, some improvements there. Then we look at operating cash flow that increased 38% to $54.3 billion. Pretty crazy. Free cash flow improved to an outflow of $3.3 billion compared to an outflow of $18.6 billion for the trailing 12 months ending March 31st, 2022. Then the last two things here, free cash flow less principal repayments of finance leases and financing obligations, also improved to an outflow of $10.1 billion compared to an outflow of $29.3 billion. And the last thing here, free cash flow less equipment, finance leases, and principal repayments of all other finance leases and financial obligations, that improved to an outflow of $4.5 billion compared to an outflow of $22.3 billion. So all in all, as you can clearly see, the business is improving and improving pretty fast, in my opinion. And it's been a long time coming, right? Finally, a business like Amazon show us how profitable you can get. Of course, when you look at operating cash flow, you could have seen this coming, and you could have seen this in the last couple of quarters as well. But now, really, we can see the effects all around. And so to conclude, while AWS is still probably the most important part, or one of the most important parts for the business, let's not forget subscription, advertising, and third-party seller services. Those are all segments that are growing much faster than the lower margin segments for Amazon, so more profitable, and that will basically lead the company to be more profitable over time. Then when we'll have lower inflation, when the macroeconomic environment, let's say, comes down, or at least we know what direction we're going in, I think the clarity here will be much better. Those segments of the business, those faster growing businesses will reaccelerate, while the online stores will continue to grow, of course, at lower margins. But since the faster growing segments are going faster and are more profitable, I think over time we should see this effect at the bottom line for Amazon. So overall, still my second largest position in my portfolio. I have no intentions of selling 1 cent of this great company, but of course do share your thoughts down in the comments below. And if you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye bye.